This this is my first video after about a year, and I want to continue my thoughts about the economy in general. And first, starting off with the stock market, we had about 700 points drop last week. It's all an indication as to the direction of the stock market. And One indicator that the most traders, professional traders, look at in order to determine the trend is the moving average. Moving averages are either 50-day, 100 days, or 200 days. Basically, it's the average price of that particular securities, stock, or any type of investment, real estate, cryptos, for the past so many days. So as far as your investment, where you want it to be is no less than 200 days, because that's the cutoff. That's where, basically it's a danger zone, okay, for stock trading or securities, what have you, or any kind of investment. As I said, again, it applies to all across the board. And right now there's some interesting stats. First of all, the S&P touched the 200-day moving average 2 times just recently. And the Dow Jones, it's trading on way below the 200-day moving average. And NASDAQ just passed 100 days and moving towards the 200-day moving average. So what that means, all of that is, again, moving average. It's basically it's an indicator that shows the momentum or the trend of that particular investment. So that's something to consider. That's just one point that you want to consider. There are several. Another one is the corporate buybacks. On average, corporations, when they buy back their own stocks from the shareholders, for the past maybe 10 years or so, it's been about $200 to $400 million. That's been pretty much average. Last year, it was over $1 trillion. So that is huge. That's needless to say, as Donald Trump, huge. Why is that so significant? Because generally, when corporations buy back their shares, it helps them. It helps basically fatten their wallets. It increases their salaries, bonuses, and whenever you see that happening often, or that volume increases, is generally historically, let's say, is when they want to basically go through for bankruptcy, or they basically just want to bail out, and or they know where the trend's going. They know that the stocks are either crashing or what have you. So they have some insights that average people, average consumers such as myself or you will not have that type of information. So that's another indicator, basically, that you want to consider. And another one is we've had really low interest rates for the past maybe 7-8 years or so, unusually low interest rates, and government, the Feds maintain that low interest rate, and that has boosted the economy, which is a good thing. And once the economy it actually grows, then the unemployment rate is reduced. And when the unemployment rate is reduced, so it's like a domino effect, which is a good thing, obviously. So fewer people are unemployed. And so when fewer people are unemployed, they can spend more money. People can spend more. Average consumers can spend more money. And now the trade-off is, whenever people start spending more money, it creates it results in an increased inflation. So so what happens is, whenever the inflation is increased, the interest rates, government or the Feds assume that for two reasons they're going to increase the interest rate. One is generally when the economy is doing great, that's the time that they want to raise the interest rate. That's they want to sneak that in because more money in banks' pockets. Obviously, they make more money on the earnings and yield, and so people really and consumers are not really phased by a little bit of higher interest rate when the economy is doing well, supposedly, right? Kind of like what we have right now. Right now, we're towards the end of March of 2018, and all the media and news telling us that the economy is great, unemployment is low, strong economy. So that's good. I mean, so basically, this is all fine on the surface because it gives the consumers a boost of confidence that, hey, you know what, I can go spend money and I'll be okay, right? So that's generally, for those of us that have been in the market for a while, or we know that this sounds familiar. But why? Because around 2006, 7, we were on the same boat pretty much. The economy seems to be pretty strong. People were spending money. Once the interest rates are raised, now the monthly payments on goods and services and real estate and everything else is increased for the obvious reason. If let's say, for example, if merchandise cost $100 and the interest rate is 3%, we're only paying $3 a month. And now all of a sudden, if it's increased to let's say 6% or 5%, now we're paying $5 for that same merchandise. Now you multiply by thousands. Like let's say you buy real estate, or you buy furniture, cars, boats, what have you. So you multiply that by put a few digits in front of it, so you can see that it's significant. And then increased interest rate, people obviously cannot afford to spend money as much. So what happens then? It slows down the economy, the growth, right? So once the growth is slowed down, now feds or government come up with the excuse that we want to just basically handle or put a cap on the inflation. So, and it does actually help when the economy slows down, less when people spend less, then it just basically it slows down the growth of the economy, and the inflation goes down. And unfortunately, the unemployment goes up. Why? Because people are not spending, they're not purchasing merchandise and goods and services. And the companies that provide those goods and services, they have to lay people off. So once that happens, you can see the vicious cycle. So obviously, if they cannot keep their employees, now I'm going to adjust this screen here. So once they cannot afford to keep their employees, they're not selling their products or goods or services, they have to lay people off. And once that happens, there we go. So the vicious cycle that we talked about. So people they're unemployed. The goods and services that they would have bought in a good, healthy economy, they cannot afford to purchase those. So now that's all fine and dandy. Now what's the solution? What are we supposed to do? Now my thought, actually, just to put in my 2 cents, whenever that happens, generally, not just that's not what I'm saying, but what investors say historically, you have to basically hedge against what it's coming. So let's say stocks, and usually 9 out of 10 times real estate follows stocks. So whenever stocks are the price, there's a sell-off or there's a stock market crash, usually the real estate follows, for the obvious reasons, right? So to hedge against that, generally, traditionally, it's been precious metals, gold, silver, and so forth. That has held up pretty good, actually. And so as the stock market crashes, people take their money out. Some people get wiped out, right? So, but some other ones, better investors, and they before the economy or market crashes, they take that money out, wait till everything, the noise go away, so to speak. So what they do with that money, instead of now, obviously there's not much earnings in the banks, so you cannot earn that much money in the bank. So they take it put it in another investment. So if the stocks are down, real estate's down, generally, again, historically, precious metals, and now for the past maybe a couple years or so, it's been cryptocurrencies, and very risky investment, but it seems like it's a fairly decent hedge against the crashing stock market. So on that note, it's it would be wise to do something, okay, rather than just waiting. It's kind of like the Titanic. If it's going down, you don't want to just be playing the violin, as I'm sure everyone's seen the movie Titanic. So you want to do something. You want to either jump on a boat, just do something. You got to save yourself. And this is not. I'm not crying skies falling, but it's always good to be prepared. So if the economy continues to be great, awesome, everybody's fine. Business as usual. However, if it's not, if it's going the opposite direction, you got to be prepared. That's all. So it's like anything else in life, right? So if you can basically consider, both pros and cons, and see both scenarios and prepare yourself for both scenarios, then we'll be fine. It's kind of like, people purchase fire insurance, not because they know for sure, their house is going to catch fire. No, but just that one time, if it happens, or if they install security systems, or they install sprinkler system, what have you. So just that one time, it could save lives. So my motto in life is to be prepared, even if I'm prepared, a month earlier, a year earlier, 5 years earlier, than being late one day, or 1 week. So that's basically what I have to say. It's I like to be doing more of these videos. If you like the video, I would appreciate giving it a thumb up. And and if there are any topics that you guys want me to talk about, I'll be more than glad to talk about that. But I will put out more videos, and hopefully you'll enjoy. Thank you.